Let me tell you about two investors. The first one is Sharp. He reads financial news every morning. He watches market movements throughout the day. He buys and sells based on trends, tips, and gut instinct. He feels in control. Active. Smart. Like he's playing the game at the highest level. The second investor is almost boring. She sets up an automatic transfer once a month. Puts money into a simple index fund. Never checks it obsessively. Never reacts to market crashes. Never tries to time anything. She just keeps going. Month after month. Year after year, 20 years later, the first investor has average returns. Some big wins. Several painful losses. A lot of stress. The second investor has quietly built extraordinary wealth. Without drama. Without expertise. Without spending a single hour glued to financial news. And here's the part that should make you stop and think. This is not a hypothetical story. This pattern plays out in real data across millions of investors worldwide. And it completely destroys one of the most persistent myths in personal finance. The myth that extraordinary returns require extraordinary skill. They don't. And in this video I'm going to show you exactly how completely ordinary investors consistently outperform the experts. If you want your money working harder than you do, hit the subscribe button and give this video a thumbs up if this helps. Alright. Let's start with a number that changes everything. 92%. That is the percentage of actively managed funds that underperform the S&P 500 index over a 15-year period according to the S&P Dow Jones Indices SPIVA report. Not some funds. Not most funds. 92% of professionally managed investment funds, run by people with finance degrees, Bloomberg terminals, and teams of analysts, fail to beat a simple index that requires no human decision-making whatsoever. Read that again. The experts lose to the average. Consistently. Repeatedly. Over decades. And yet the entire financial industry is built around convincing you that you need their expertise to get good returns. Because expertise is what they sell. And if the simple approach works better, the product they're selling becomes worthless. So here is the first principle that separates ordinary investors with extraordinary results. They stopped trying to beat the market and started owning the market instead. An index fund doesn't try to pick winning stocks. It simply buys every stock in an index. The S&P 500, for example, holds the 500 largest companies in America. When you buy an index fund, you own a tiny piece of Apple, Microsoft, Amazon, Google, and 496 other companies simultaneously. When those companies collectively grow, your investment grows with them. No analysis required. No expertise needed. No stress. Just ownership of the entire market growing over time. But here's where it gets really interesting. Because owning the right thing is only half the equation, the second half is something most investors completely destroy without realizing it. It's behavior. Research from Dalbar, a financial research firm, consistently shows something remarkable. The average equity fund returns approximately 10% annually over long periods. But the average investor in those same funds earns only around 5%. Same funds. Half the return. Why? Because ordinary investors panic sell during crashes. They buy aggressively during peaks. They react to headlines. They move money based on fear and excitement rather than strategy. They interrupt compound interest at precisely the worst moments. The market goes up over time. That part is relatively predictable. What's unpredictable is whether you will stay invested when it feels terrifying to do so. And this is the second principle of ordinary investors with extraordinary returns. They mastered the most valuable skill in investing. Doing nothing. In 2008 the market dropped nearly 50%. Millions of investors sold at the bottom, locking in catastrophic losses. The investors who did nothing, who stayed exactly where they were, saw their portfolios fully recover and then grow to record highs within a few years. The extraordinary return didn't require a brilliant strategy. It required the discipline to sit still while everyone else panicked. Now let's talk about the third principle, and this is the one that creates the biggest gap between ordinary and extraordinary outcomes over time. Consistency beats timing. Every single time. There is a strategy called dollar cost averaging. The concept is simple. You invest a fixed amount at regular intervals regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, your average cost per share becomes lower than if you had tried to time the perfect entry point. And here is the beautiful part. Studies consistently show that even investors who started at the worst possible times, right before major crashes, outperform investors who waited for the perfect moment, because perfect moments never actually arrive. The investor waiting for certainty waits forever. The investor buying consistently builds wealth despite uncertainty. Time in the market always beats timing the market. The fourth principle is the one that quietly multiplies everything else. Keep costs brutally low. This sounds boring. It is not boring. A 1% annual fee versus a 0.05% annual fee sounds insignificant. Over 30 years on a $100,000 investment, the difference costs you approximately $170,000 in lost returns. Not because of bad investments. Simply because of fees compounding against you instead of for you. Index funds typically charge between 0.03% and 0.2% annually. Actively managed funds typically charge 1% to 2%. And as we already established, the expensive option underperforms the cheap one 92% of the time. You pay more to get less. Consistently. Extraordinary investors obsess over costs not because they are cheap but because they understand that every dollar saved in fees is a dollar that compounds in their favor for decades. So here is what the ordinary investor with extraordinary returns actually looks like. They own simple low-cost index funds. They invest consistently every single month regardless of market conditions. They ignore financial news designed to provoke emotional reactions. They never try to time the market. And they let compound interest do what it does best, which is work silently and relentlessly over long periods of time. No genius required. No expensive advisor needed. No hours of research every week, just consistency, patience, low costs, and the discipline to stay in the game long enough for ordinary inputs to produce extraordinary outputs. Because in investing, boring wins. Almost every single time. If this changed how you think about investing, hit subscribe. And tell me something. Are you currently invested in the market or are you still waiting for the right moment? Drop it in the comments because that answer tells you everything about where your financial future is heading.